Hello and welcome to today's discussion, Evolving Capital Markets, a new normal for corporate actions. My name is Bradley McLean, co-founder of Regulation Asia. Corporate actions are placing ever-increasing demands on the resources of financial institutions that cater to investors. For the most part, regulatory pressures in this area have remained light touch, at least for now. And many institutions still heavily rely on manual approaches to monitor and manage corporate actions. And this is what brings us here today to discuss how the capital markets landscape has changed and how this impacts the complexity of corporate actions and presents new risks. Joining us today in our panel of experts is Barnaby Nelson, Chief Executive Officer at the ValueExchange. Barnaby has worked for over 15 years in the Asian post-trade space. Most recently, he led Standard Chartered's custody business in Asia. And prior to that, he launched BNP Paribas custody business in Asia. At the ValueExchange, Barnaby's attention is now focused on delivering statistical insights on the market dynamics, including corporate actions and related areas. Welcome, Barnaby.
Thank you very much, Brad. Nice to be here. Thank you for the invitation.
Next, we have Gary O'Brien, Head of Broker Segment Strategy at BNP Paribas Securities Services. BNP Paribas provides global clearing and custody solutions to different financial institutions and corporates around the globe, including local market activity in 27 markets that are going through a variety of market changes, many of which are adopting their corporate actions workflow currently. Now, Gary has been with BNP Paribas for over the past 15 years and has extensive experience in working on change and transformational projects. Welcome, Gary.
Hi, Brad. Thanks for letting me join the panel as well.
We also have Alan Chung, Senior Vice President of Depository and Nominee Services Department at the HKEX. Alan has been with the HKEX for over 2 years, managing nominee services, structured product, and stock administration function for the HKSEC. Prior to working at HKEX, Alan spent over 15 years in various operational functions within investment banks. Welcome, Alan.
Hi everyone, thank you.
And finally, we have Ankush Dutti, VP Corporate Actions and Securities Processing at IHS Markit, where he heads the product and business strategy. Ankush specializes in managed services, data and technology solutions for corporate actions, asset servicing, and post-trade securities processing. Now, with over 20 years experience in the space, he's also part of various security service industry working groups on the latest standards, technologies, and regulations. Welcome, Ankush. Now, before we begin, I'd like to remind our listeners to use the Q&A box in the Zoom app to submit any questions throughout the discussion. We'll try and reserve 10 to 15 minutes at the end of the discussion to really address these questions. Now, as we start, as a kicking off point on the key issues that the industry is facing in capital markets is the increasing volume of corporate actions. Now, to set the scene, Ankush, I was hoping you could walk us through some of your recent research about some of the key developments in capital markets that have been impacting corporate actions.
Thanks, Brad. Thanks for having me on the panel. We're looking forward to a great panel discussion. Definitely corporate actions any day of the week and have always been quite a manual and risky process. But if you lift the hood, take a deeper look at why that's happening, why these challenges are increasing, they have emanated from multiple factors. One aspect is the new capital formation and new raise of issuances, which is then further supported by global asset and wealth and pension assets growth. Another aspect is the tweaking of investment strategies, whether by individuals or firms, and rebalancing of the portfolios going towards more global asset classes, global markets, etc. And just to throw some stats to kind of quantify this whole change over the years. The global AUM by money and wealth managers, that is supposed to grow by 5% by 2025 to $147 trillion, and same kind of growth in pension assets. By 2025, we expect more than more than 65 trillion. In 2019, it was 50 trillion. And also, if you look at the flow into asset classes, passive funds, they had more inflows than active over past 10 years. They got in $2 trillion as compared to active, which saw outflows of 1 trillion. And that trend continues. In 2020, they again got 750 billion. And when you talk about diversification, look at the emerging markets capital flows. Last 3 years saw 850 billion with 360 billion plus in 2020. So all the capital controls in various emerging markets, they are being removed. Regimes are being liberalized. Look at QFI in China. Look at the China index inclusion. and couple all of that with the retail trading frenzy that we have witnessed recently. We have seen record trading volumes, a lot of retail wealth going into new trading platforms. And even then, the global mutual fund flows are continuously increasing. So they nearly doubled in 2019 to 1 trillion. A lot of them went into fixed income, which again, in spite of the low interest rate and a negative $18 trillion debt across some European Asian markets, you see the interest in those asset classes growing. If you just look at equity, and we all know equity markets are back from the deep plunge they took in March 2020. Now all the indices across major markets in Asia and otherwise, they're back to their 5-year highs. But just look at 2020, the year of the pandemic, the issuance surged to 1 trillion for first time in history. And SPACs, the special purpose acquisition vehicles, were the hottest trend on Wall Street to raise capital. The whole issuance in 2021 up till March, around 97 billion in funds. That has already surpassed the whole of 2020. And even Asia headquartered SPACs have raised 2-3 billion. So there is this whole trend which is also coming towards markets like Singapore and Hong Kong, and probably we'll see this growing there as well. And beyond SPACs, even the traditional IPO growth has been phenomenal, 50 to 60% year on year globally in 2020. Mainland China and Hong Kong dominated that with 70% of the IPOs, and that's just equity and fixed income. Governments, corporations, they're building their war chest to fund economic growth, recovery, and the debt issuance soared as well in 2022 to the highest of 10 trillion. If you just look at Asia and look at China, the bonds now stand at US $17 trillion. That changed from 70% of GDP to 110% of GDP today, 70% of GDP 5 years ago. So what does all that mean when you look at these stats? It means now the whole ecosystem, the firms across the markets, they have to process corporate actions for a much larger number of markets and asset classes, and each of them come with their own market nuances, how those corporate finance transactions are structured. And just to give you a figure, so compounded annual growth rate in last 2 decades is around 15%, just based on the new instruments issued and traded. And when you look at these kind of new issuances like SPACs and the corporate actions that come with them, they have a combination of units and warrants, cash out features, then they go through business combinations, extensions. That life cycle itself, that requires a whole mix of corporate actions. And these are just some of the challenges, and when you throw in some of the regulatory drivers along with the industry fee and margin compression, if you look at SRD2 in Europe, which also applies to Asian financial institutions, Australia, New Zealand, Hong Kong, China, these countries hold around 5% or many trillions dollars in European companies. So the directive that requires them to be timely about passing of corporate action or meeting information and facilitating shareholders voting and election through latest ISO standards, all that is applicable to Asian intermediaries as well. And then we have LIBOR, right? So we think it's December 2021 is the end, but some tenors will continue to 2023. In Asia Pacific, new instruments are still being issued linked to LIBOR, and we have around 560 issuances, $200 billion bonds, and they don't have sufficient fallback provisions to switch to a new risk-free rate, and what would that result is in a number of consent solicitation or bondholder meetings kind of corporate actions. And then there is the ever giving gift of tax, which just keeps on giving. And CRS frameworks, automatic exchange of information, that all of that combined together, that is what is kind of increasing the complexity of corporate actions for firms.
So complexity is probably the right term. I mean, from SRD2, we talked about Singapore, China, SPACs. I mean, there's a lot to really unpack there. I mean, Gary, you're in a really unique position, being a regional custodian. I'd be keen to get your thoughts on the challenges you've seen over the past year. Where has been the focus, and how have your operations teams been impacted?
Yeah, I think Ankush has obviously given some very clear and detailed overview of the different situations and market changes that have, or market conditions that have impacted a lot of the world. And it's certainly the case that that those have had a number of impacts and questions raised for custodians like ourselves and other intermediaries. I think obviously over the last, let's say, 18 months, as more so than 12 months, the biggest factor for operational processing, operational models has been the pandemic situation and how that's impacted the ability or the working structure of organizations. The fact that operational teams in, I would say, most organizations around the world have had to move to split or from home working arrangements has obviously had a massive impact on things, and particularly in the corporate action space in Asia, where we still have markets where we need to send faxes, or we need to have wet ink signatures, or we have to physically pay stamp duty payments, or we have to make a check of controls. The reality is that some of those items have had to be rethought, or have our, let's say, extreme risk or BCP scenarios applied to them so that they could be completed in the right way. So that's one aspect of the operational impact that scenario and situation has had on us. But related to that as well, and Ankush mentioned it as well, the very fact that the markets have been volatile, and as a result, the volume of settlement transactions has increased, has a knock-on impact to corporate actions, because the volume that is going through, especially during a corporate action period, has a lot of impact on operational processes around validating entitlements, validating the who is entitled to participate and to what level, especially during a time where people are pushing to reduce or improve election deadlines and so on as well. Anyway, that's having a big impact. It's also having a big impact on our clients, because the right decisions for them to take are changing almost hourly based on that volatility of the market. So again, the flow-on impact of that downstream can be quite significant. But then again, in a region like Asia and Asia Pacific particularly, the nuances market to market, whether it's based on how you need to interact with the market or just the event types themselves, can have a significant challenge and question mark for providers. So it's fair to say that whilst we're in a role that benefits from difference and not having a cookie cutter approach market to market from processing, because it makes it clearer the role that we play in the ecosystem. Maybe in the last year there's been so much change and so much difference that's really had an impact for us.
I like how you put that. I mean, when you look at the challenges of Asia, putting the last year aside, I mean, it's that the nuances market to market. I mean, Alan, you know, from a Hong Kong perspective, what are the big themes, challenges, trends? I mean, what are the pressures moving forwards that you see that will further shape the corporate action space?
Sure. So I think in general, right, I think even for the Hong Kong or the stock connect market that we are supporting for China A stock, it has always been challenging for corporate action space in terms of the kind of the volume that is kind of condensed in a short period of time, for the markets for us to prepare and for the markets to process and process to the individual investors to the end. I think that has always been a challenge. For the past year, especially under the pandemic environment, we do notice that as in the very first-hand information from the issuers around the shareholder meeting, there has been a lot of different arrangements that are being organized by the listed issuer. We're seeing a lot more virtual meeting, hybrid meeting, and also the attendance of meetings with very limited seating, where it can be first come first serve basis, or you need to pre-register with a notary kind of arrangement. So all these all these different differences and I guess kind of new arrangements, we need to check with almost each of the this issuer about how they are preparing it from the end, because otherwise the information that we pass through will be incorrect. So I think that we're seeing a lot more under the pandemic environment, and that remains a challenge. I think even this year, we're still seeing a lot of different variation. The other thing that we are seeing more is around the regulatory space, where I think Ankesh also mentioned a little bit about the SRD2, with the implementation of the SRD2 addressing some of the kind of the shareholders, I think tightening of shareholders, I would say rights, and in terms of how the shareholders can get more timely information, what is the SLA, etc., that's imposed by certain jurisdictions in EU. I think it has been kind of a topic that we are also working on, since we have quite a few major listed issuers from the EU and UK space. So I think that is something that we need to ensure that we ourselves comply, as well as the market also are doing the compiling with the end in the Hong Kong market, so that we are not kind of breaching anything. So I think that is another thing that we're seeing more attention from the market around the regulatory space. In terms of some of the challenges ahead and still remain as challenges, I think Gary pointed out there that there are still a lot of paper instructions that still need to be processed, even in the Hong Kong market. We are submitting every single instructions with WEC physical needs to be submitted to our share registrar by the cut-off time, right? I think that part is fairly manual and involves a lot of risk, especially during the COVID pandemics environment, where we all planned about the BCP arrangement, or we will all want to work from home. These kind of imposes a great challenge for us and for the market to follow. We kind of always have kind of reliance on the physical space in the office, where we need to have a few people arranged to really sign the documents. But having said that, we have worked out with our share registrar in terms of the kind of the BCP arrangement, where during where scenario we cannot sign the instruction, what are the alternative way can we do it? And also it's probably a bit unique to the exchange. It's about the physical certificates that we need to process. Maybe from this custodian perspective, they don't see the certificates, but from our perspective, for every exercise of instructions or distribution of some kind of stock, we're still handling the physical certificates. So imagine during COVID situation, if we cannot have that physical interaction with the share registrar, it becomes a challenge for us to kind of process the either the instructions or the payout of physical securities to our underlying shareholders. So I think that still remains a challenge for us, and a lot of our payments are still using check payments issued by the issuer. Nowadays, we're all using our mobile phone to make payment electronically, instantly. But you can imagine that we're still using a check with billions of Hong Kong dollars on single check, and we still need to clear it one by one. That is also something that we are looking into, and we can talk more about it, what we are doing about the digitalization of payments as well later. But this remains as a challenge for us. And I want to say that we have quite a few different projects in place where we can kind of, I would say, improve the experience in corporate action and make the information a lot more structured. For example, one of our projects that we are rolling out recently is the corporate action messaging system or standardization, the CAMS project. It's something that we are aiming to do, is to make the notification to the market in a more standardized way, more structured and timely, so that the market does not have to go through hundreds of pages of annual reports or prospectus offering documents, but the information should be more summarized and readily available. So it is something that we are preparing. I can talk more about it later.
Excellent. I mean, I just wanted to go back to one of the points you had there that was really around the payment areas. I mean, we actually have a poll question, which is audience participation time, that really kind of drills down on the issues of manual payments and payment errors. The question is, have costs associated with corporate actions increased or decreased in the past 12 months? The options being increased, stayed the same, or decreased. Well, everyone's considering that. I mean, Barnaby, as I understand, this is actually an area of your focus in research. And I mean, transparency around the real cost of errors in corporate processing has been challenging. I mean, what did your research find in this area?
Yeah, look, I mean, I think the conversation so far has been fantastic in terms of highlighting very much the sentiment of what we find whenever we speak to anyone in the corporate action space, which is this is a problem that we've been carrying with us for 20 years for many of the points that Alan mentions around, you know, a lot of legacy challenges, but then you add to that everything that we've talked about in terms of what's happened in the last 12 months. You know, there's a real sense of breaking point here. But you know, for me, what's absolutely key is that the whole corporate action space is costing us an awful lot more than we thought. You know, when we ran a survey of corporate action processing all the way around the world last October, you know, APAC or Asia was by far and away had the highest incidence of people paying out more than $2 million in corporate action errors. So that's just literally just the amount of money that basically hits the cost center of whatever it is, the bank or whoever, you know, basically just because of corporate action errors. And that's significantly, as you can see on the left, it's significantly higher than anywhere else in the world for many of the reasons we just talked about. But I think, you know, so that's the kind of tip of the iceberg. But, you know, what's equally important is the fact that actually even that number, which anecdotally most people would probably say it was closer to 3 or 5 million, not really 2, but you know, even that number isn't actually the biggest cost that we're carrying, because every time there's a corporate action error, as I'm sure many of us have been involved in, you have the, you know, the 2 or 3 day fire drill when basically you have an enormous customer impact, very, very substantial in terms of financial and obviously customer satisfaction. You have, during the fire drill, you have enormous amounts of extra hours work to remediate, loss of face going to the, you know, the CSD in whichever country it is to beg for an extension. And then, you know, the fact that the CEO is pretty much always involved in those conversations, you know, the management time that gets sucked into remediating corporate actions. It's non-trivial. And so, you know, so for me, the basic point really is that, you know, corporate actions, the problem above the water in terms of the iceberg and below the water, it runs into the millions of dollars for any shop that you speak to, and that's US dollars, by the way, not honky. But I think if you dig down into what that is, and I think on the next slide, you know, I think for me, what's so key is basically where is this data? Where are these data coming from? And, you know, fundamentally, there are so many processing, wet ink, all these kind of processing related areas. But, you know, it is about the data. 6% of the issues that we experience on a regular basis are related to incorrect data, incomplete data, or late data. And, you know, realistically, it's not to say that errors don't count for a lot. I mean, manual errors still count for 30% of the problems. So it's not like we can just wave them through. But at the end of the day, if we could get the data right, and this isn't a sales plug for Alan, but if we can get the data right on the way in and run it all the way through correctly in a kind of trusted way that basically doesn't get corrupted and doesn't get messed around with, then we can see a real meaningful impact. So on the right, you can see that basically what this really says is that where people struggle is to get the data or to get the event notification into their organization, and then to be able to communicate that event back outwards at the end to either authorities or to their clients. So essentially, it's a very expensive problem that not many people would acknowledge. It's getting worse, as you can see. And you know, I would argue it's at breaking point after 2020. And ultimately, data is really at the kind of absolute foundation of all of that.
Gary, do you agree? Are we at breaking point? I mean, look at the results here. It seems resounding. 74% of the audience have said, look, the corporate action errors have increased. In fact, we have our next polling question that is actually looking at what are the primary reasons for the corporate action failures at your institutions. But Gary, initially, what are your thoughts? Does this make sense with your expectations?
Yeah, I think it does. I think I'd agree with the poll results as well. And again, we talked about some of the rationale and reasoning for that, but it, in a way, it still doesn't make it okay that's been the situation. I think it's fair to say again that we're living in 2021, and I think Barney kind of mentioned it. We're living in 2021 with processes in our corporate action space that have been around for in some areas for 20 years, and so it really is time to evolve that and find new ways of doing things. And again, yes, the pressures we've been under over the last 12 to 18 months have certainly highlighted that more. But unfortunately, it probably should have been obvious to us prior to the pandemic as well.
So while everyone's just completing the poll question about the primary reasons for the failures, I mean, from your perspective, Gary, I mean, are you saying that we're facing the same pain points today as we did 20 years ago?
I mean, in some areas, yes, unfortunately. Again, things like the faxes, things like manual payments, they're pain points that we had 20 years ago, but 20 years ago, we didn't have solutions to them. So they were the way to do things. Whereas today, as Alan highlighted, we have electronic payments, we have electronic workflows that we can go through. It really is just about integrating them and implementing them and prioritizing their implementation in our processes. I think Alan's very right that in Hong Kong as an example, and it's just an example, there are many other markets like this, that there are downstream requirements, maybe regulatory requirements, regulatory framework that is causing the need to have manual touch points in our workflow. And to my mind, we simply need to work together to remove those barriers, because even if we as a custodian, most of our upstream workflow is automated. We send SWIFTs to our clients. We have API connectivities to our clients. We have file transfers, everything. And then we receive instructions in the main back in automated means, again, via SWIFT or file or GUI interface and so on. But then sometimes downstream, we have to move to a manual process because that's the process of that market. Or even, as Alan says, if we can provide it in a manual way, then when Alan receives it, because of the downstream requirements, he has to move it to a manual flow. So that impacts on the timeliness point, and again, under SRD2, that's important, but it just impacts on the risk. And I would argue that historically, the point of things like wet ink or validated processing was there because when we looked at the risks of alternative models, the risks were too high. But with some of the advancements we've seen, we probably need to revisit that decision, and probably we've come to a different conclusion that the risks of the manual process now outweigh the risks of the more automated, low-touch processes that we could implement.
I mean, you touched on some interesting areas. I mean, when we look at the results from the poll, manual errors are really right up there, but we also have incorrect data. I mean, Barnaby, from your research from last October, I mean, is this reconciling with your research? And if you were to refresh that research, how do you think it would change?
Yeah, no, look, honestly, I think this is absolutely consistent. I mean, it's basically, you know, the unfortunate point is that there is no such thing as there's almost no such thing as absolute data quality anymore. It's just, you know, there is so much corruption and there is so much corruption as you move from the issuer all the way through to the investor, that basically it's everyone is in an arms race now to try and work out what they're looking at. They have been for a long time, but I think to Gary explained it really well. The data comes in, no matter whether it's good or bad. It still gets handed over to a bunch of people to check and to type out and to read off the facts, send it through. It's no wonder that kind of information gets corrupted really quickly, particularly in the many markets in APAC where there is no alternative. Where if more than half of the data sourcing is off a website, then you can understand that there is an awful lot of doubt about whether you're looking at the right data or the wrong data. So I think incorrect data is endemic, and I think what people often miss also is whether they're part of the problem in terms of the everyone always says, yeah, I'm being fed rubbish data at the top end, but are they actually distributing rubbish data? And I think for me, that's one of the big things is if they are a prime broker, if they have, downstream clients, wealth management clients, custodian clients, are they really, actually publishing the best data that they possibly can in the most reliable, consumable way? Not entirely convinced that everyone would say yes to that.
So I quite like the way you put that in terms of asking the question, am I part of the problem? And when we look at the challenges that Ankush mentioned, right, from the outset, corporate actions events we're expecting to increase exponentially in volume, more complexity, more errors. Barnaby, from a technology perspective, what needs to be done?
Well, so to be honest, I know, because we may have had a conversation before this, and I know that we've got some great technologists on this call. So I was actually, for me, there's a step that we have to get to before talking about the technologies, because as Gary says, we have some incredible technologies being deployed in some of the markets around the region. Thailand, Malaysia, Hong Kong are using, they're looking at DLT, not to mention Australia. So there is a fantastic convergence going on at the moment of good technology and new technologies rather, and acute problems. But I do think, going back to this, are you part of the problem? I think for me, there are very consistently, everyone I've spoken to in the last year about corporate actions has said, yeah, the thing is we just wait until it all goes wrong and then we invest. And so realistically, the biggest problem isn't the availability of technology, it's actually getting on and using the technology. And so I think for me, that there are many steps that we can all be taking actually in order to understand the value of the technology that's out there in terms of, going back to the business case. Do we understand the true cost of corporate actions in our organization today? I don't think we do. Are we able to actually accurately diagnose where in the organization those costs are being driven from? Is it wealth management? Is it prime brokerage? Is it certain types of events, certain types, are we able to zone in? Because the number of corporate action projects that fail because they're too big, too ambitious, too wide, and are therefore unable to deliver is surprisingly high. So I think for me, technology, absolutely, but the business case that precedes it in terms of what you're trying to fix, what the worth is of that fix, is absolutely crucial. And probably, I think, one of the areas that we're doing worse than the actual technology on.
Gary, what do you think? Do you agree?
Yeah, I think I might sidestep for a second and say, obviously, what if we look at, let's say, the traditional asset space, one of the biggest challenges to the traditional asset space right now is the digital security space, and the evolution that is happening there to create a whole new range of asset classes in a completely digitized model and digitized environment. So anything that continues to have these manual touch points and therefore delays in process, perhaps more risk in the flow compared to that space, automatically has a risk of losing market share, losing market focus. So with that in mind, you just have to look at what are the solutions that the digital security space is focusing on and bringing into the market. And Barney touched on things like distributed ledger technology. Obviously, alongside DLT, a big part of that is smart contracts and the capability that they can bring to workflow processing and etc. Just basic things these days like electronic signatures, more automated workflows and monitoring solutions. These are things that are baked into these new markets, new solutions that essentially we have to copy and paste across and replace the legacy processes that we had. Otherwise, I think we are going to see a massive shift as the digital security space grows away from the traditional workflows, the traditional providers and players in the marketplace.
I mean, Ankush, you're our resident tech guru. I mean, what are your thoughts?
Yeah, I think Barney and Gary and Alan, and they put across very relevant points. And Barney has clearly articulated the quantitative business case behind the need of technology and data, and similarly all other challenges that are prevalent across the ecosystem, right from the CSD and issuers, etc., that Alan talked about. So from my perspective, it's the same, ecosystem thing, which means every participant in the entire ecosystem, right from the issuer to the CSD, down to the custodian, prime broker, to the asset manager, they all have to look at both their data and technology strategy. We've talked about processes being there for 20 years. We know, talking to customers, these things are still being processed on Excel sheets and people sourcing data manually from websites. But again, when you look at modern workflows, we talk about these new digital securities. We talk about modern workflow technology tools that are based on latest standards. You should also look for digital capabilities where you can interact with the whole stakeholder chain in a much more seamless fashion, whether through APIs, whether through modern digital channels, and the technology cannot always be also one size fits all, because the technology processing requirements keep changing from a buy-side fund manager's perspective as compared to a prime broker who's more focused on synthetic financing, securities lending, etc. So it's also different people need different versions of the same technology. But I wouldn't say just the standardization and technology is sufficient in itself, because the underlying way these corporate actions are structured and these transactions are done across the markets, that still varies to a great extent, and that it comes back to the same point, one that Alan was raising as to how do we get issuers to get data to us in a structured fashion, and second that Barney talked about, right, like how do we this whole data aspect where more than 50% of the errors are related to data. But if you lift the hood and you start going to each market and you look at Australia, how they have a rapid offer with 1-day institutional period, how they do a share repurchase plan with fixed parcel, minimum maximum quantity. You go to China, you look at put events on Chinese traded bonds. They don't even have a CDOL. They use a local code. Taiwanese rights issues have their own nuances. There is a subscription period. Korea does not announce a dividend 38 days after exit. So how do you get across all these problems? This requires a massive coordination globally across how the corporate action should be structured, and I don't know if that's going to change or not. But that is where you need to get the data right, and you need to have the right data strategy, right operating model, where you can leverage the global market expertise. You have experts in each of these markets. Plus, you can also scale up and down. When we talked about the effects of the pandemic, Gary touched upon it, Alan touched upon it, and last year, we are a managed service provider supplying data, and we saw a huge, considerable spike in meeting cancellations, dividend cancellations. There was so much more work that the industry generated just around getting the data right. 3,000 plus dividends being canceled, 632 bankruptcy records, 5,000 dividends extended. So, I mean, the upheaval in the space was huge, and that's where the right data sourcing strategy and the right operating model can help the firm. So technology alone won't do the trick. The market nuances are there to stay, and you need to, in the short term, you need to at least work around them.
Okay, I mean, it's interesting how you've mentioned technology and global coordination. I mean, I'd like to do our last poll question for the session, really delving into, from the audience perspective, you know, how does your firm currently process corporate actions? The choice is, you know, manual processes, proprietary corporate action software, third-party corporate action software, a mix of manual and automated processes. While everyone's, you know, reflecting on that, Alan, I'm keen to learn around from a corporate actions perspective, you know, what initiatives are in the pipeline at HKEX?
Yeah, so I can share with you a little bit about the past first. The past, I'm talking about maybe 2 years ago. It would have been fully manual. From the moment we got the unstructured information scattered around the 200 pages announcement to the part that where we need to extract and put it in our system and send it across to our hearing participants to further process, right? I think that whole thing is a complete manual process. So we've done a couple of things in the past couple of years. The number one is around the, we have created an AI with our third-party vendor together, and to kind of scrub through our those public announcement from the company over our websites. So there are thousands, really thousands of them being posted on our website every day. So the software will help us to firstly scan through which are the ones that are relevant. And secondly, if there's a relevant document, they will try to read as we read it as an AI, is AI, right? So as we read it, what are the key information that needs to be extracted, and what kind of event type that is being classified. So that helps us quite significantly, not just on the, I would say not just on the, I guess, the timing perspective. I think that's one thing, right? It is the turnover time should be a lot quicker than us. But I think the other thing is around the, I think, accuracy, as well as we kind of improve the kind of the work environment for our staff, right? We don't want them to feel like day in, day out, all they do is just reading documents and finding some information, extract some information from documents. So we want to kind of enhance that work experience for our staff as well. It has proven to be quite successful. Of course, to start with, there has to be some kind of ways that we need to kind of, we teach the AI, right? We teach the AI how to adopt our process. But I think over time, we have a well-defined logic. I would say now it's working with accuracy over 95% every day, even during peak season. So I think that is very good. That's a very good result. Of course, it still requires our checker to check the work, the output, but at least in terms of the initial process, I think we have already eliminated quite significantly for the manual part. The other thing that we are working on is around what we call the, I mentioned about what we call camps, right? It includes mainly two parts. The first part is around the issuer will be, in addition to some of these announcements, for example, dividends or POPSI, instead of just publishing through their annual report or some of the ad hoc reports, they will be also filling out and what we call the e-form, a very structured form where they can publish into our website. So these will already, I think, improve the kind of structure of the corporate action data, and also, I would say, the timeliness as well, because people can now get the information quite instantly instead of going through all the documents again. So I think that is the first part. The second part is around the notification that we send out to the clearing participants who subscribe the service, we are offering a swift notification that can go right from the issuer input e-form and transmit into the SWIFT to the subscribed participants. So again, that will make the information a lot more streamlined. That is something that we're hoping that can improve the timeliness and the quality of data being consumed by the downstream parties. Also, of course, I mean, our seekers data, what we call it, is still going to be available and still going to be important because we have our own data, our own details that we want to enrich in our corporate action announcement. But at least that will have kind of like first-hand information available in the market a lot sooner than the past.
I mean, just quickly looking at the poll there, I mean, Barnaby, it's clear that there's a mix of manual and automated processes, but from your perspective, are these going to be proprietary or third party? And more importantly, we've talked a lot around technology. From your perspective, is there anything that's actually lacking in terms of focus?
Yeah, I think, you know, for me, it's not surprising that or people are coming back saying that there's a blend, because ultimately, I suppose the key question for me is what does good look like in Asia, especially because at the end of the day, you know, realistically, anyone who said they're fully automated in Asia, I wouldn't believe them, or that it just meant they just had some really, really cool machines typing away. But I mean, ultimately, for me, the big thing was, I always remember when COVID struck last year, I was chatting with one of the big brokers in Hong Kong, and they said, well, look, we can only afford to have about 30% of our staff working from home because we need them to be here for corporate actions every day, you know. And it was absolutely really striking for me that basically that we are still so reliant on people, you know, to do this. You know, there are fantastic solutions coming through, but at the end of the day, there is still a patchwork around Asia of markets, and Ankush ran through all of them, you know, that are highly problematic. So I think for me, there's a lot of cause for pessimism on the side that basically, are we going to get meaningful STP-able corporate action data out of 15 markets across Asia? Not anytime soon. But then again, you know, I think the biggest trap that we fall into in corporate actions is the belief that there is only one solution and one problem, one solution. You know, the truth is that I think hopefully as this conversation for me is going in the direction that there are many technologies. There are smart contracts, there's DLT, there are, you know, and DLT on a more micro basis. There is, you know, data cleansing. There are many options available that, you know, and you can apply to specific usage cases. I mean, EUCs are still incredibly prevalent. I'm not saying they're a good idea, but, you know, there are many technologies out there, robotics, they're now called, that can apply to a given situation. So I guess what I mean is basically, I don't think there's any, on the pessimistic side, there's not going to be a silver bullet. I think on the optimistic side, there are many causes for optimism in terms of the technologies, the answers that are there. If you look at the success that proximity has had in Europe, from a proxy voting perspective, incredible, you know, in terms of the time that they've got out the door and the speed, you know, the efficiency that they brought, you know, albeit just proxy voting to individual markets. It's incredible to realize how fast change can happen. And I think for me that the big point in Asia is, if you look at every bank, we're all saying that wealth management and basically prime brokerage are the two big growth businesses for everyone. Those are the two worst performers for corporate actions. So, you know, if we don't do something about this soon, our big growth areas are going to become our highest risk areas, and they're going to we're on a kind of collision course. Not to be over dramatic, but I think there is need for, you know, to use that toolbox.
I like it. You've been optimistic, you've been pessimistic and dramatic. So it's good to see.
Report,
No, it's fine. I mean, just wary of time, I just wanted to take a couple of questions from the audience. And, you know, Barnaby, you mentioned, you know, what does good look like? I mean, Gary, I wanted to ask you one question that came from the audience. And this is really around what does good look like? Do you think it's sufficient for asset owners and asset managers to solely rely on the custodian provided for corporate actions processes and data, or do they need to own it in-house or reconcile it? What are your thoughts?
Yeah. So first of all, as a custodian, I would always say that we're the source of truth, and everything is very well refined in our process. But also, as a security services provider, I would flag that as a middle office agent, we don't rely on the custodian solely as the provider of the information. We do scrub that data in our middle office role. We bring in different sources of information, and essentially we validate the different sources against different against each other to see where we may have differences and try and work out what is the right way to do that. So I think I would always argue, again, to Barney's point before, you have to take control of your own destiny in a way, and so I think there's always a logic of checking and validating what you've received in a workflow. Now, so yeah, I think what we'll find is, again, 9 times out of 10, the custodian information is passed through from other sources downstream, and so can be relied on. But just from a best practice perspective, there is probably an after the fact control that parties should be performing against other data sources to really make sure that that they're comfortable in that they have all of the information. And the same happens in proxy voting space, obviously a part of the corporate action space. People often review and revisit against a feed from a proxy voting specialist on not just the information coming in, but what is the right decision to take. So why wouldn't you have the same idea in other corporate action spaces as well?
I think, if I'm just to extend on that, I think it's a really, really essential point that historically corporate actions have been hidden behind custodians, because ultimately custodians will pay out if they're wrong. Basically, I'm not saying that that's an established legal precedent, but you know, for me, that's why investors have historically been very, I would go as far as to say they've been very lazy about corporate actions, because ultimately it doesn't cost them to be wrong. It costs the custodian to be wrong. But I think, you know, if you look at what some of the biggest pension funds are doing on earth, you know, these guys, data sovereignty is now, you know, a concern, and also corporate actions are not just, you know, they are consumed for hundreds of different reasons within major investment organizations. And so I think, you know, if you look at like ripples on a pond, you know, for a fund manager not to be actually running on accurate and to Gary's point, complete corporate actions data, it's pretty poor, you know, right now. And I think, you know, if you look at the guys who are transforming the most across the entire industry, it's the pension funds.
Okay, I mean, there is a question here actually that goes to kind of the essence of, you know, apologies. The data issues have been identified as the main reason for incremental compensation payouts. Should this be due to the fact that we're over-relying on automation as a way to reduce staffing costs? I mean, Barnaby, Gary, do you think this is one of the challenges? It's an over-reliance on automation just to reduce our staffing costs, and that's leading to the increased payouts.
Yeah, sure. I can go first. I think the way I would answer that is to say that perhaps historically automation has been in some areas focused on, how can we reduce the staff cost, and that is certainly an important focus. And then in some ways in some areas it's been about as well, how can we just simply have things automated through in a more efficient manner from a timeliness perspective, etc. So with that in mind, that certainly still needs to be a focus of automation. Absolutely, that has been and should remain a focus of automation. But with the technology that is coming through now and the options it brings, a secondary focus needs to be on how do we evolve the operating model? How do we evolve the way that things get from A to Z? Because the reality is, again, coming back to the 20-year-old point, we've been doing things the same way for 20 years. And we were doing them that way because the technology that we had meant that that was the most efficient and risk-controlled model for doing it. But as this new technology comes through, whether it's artificial intelligence, whether it's DLT, whether it's standard robotics, let's say, or APIs and many other things, the group of those technologies together should mean that we take a step back and rethink, is this still the right workflow? Is this still the right operating model to use? And I'm sure that in some areas we'll find that it isn't. And to that point, maybe we'll find that we can reduce some of these costs because we take links out of the chain, or we do more validation in an automated way than we have done in the past.
Yeah, I mean, that gives a good segue into how you can mutualize the cost across the industry. I mean, there's this set of technologies. You can do direct sourcing through RPA, Python, but there will still always be these market nuances. So when you take a look back and look at the operating model as an industry, you could look at, we are doing this reconciliation at every step. Barney talked about it. The custodian data is passing through; it's corrupted at the next step. Everybody is doing the same reconciliation at every step. So should the operating model be more like, okay, why don't we do it once in a more mutualized kind of fashion, and we get a centralized source of validated data, which solves the problem across the industry, across all tiers, segments of the whole chain, and that's where IHS Markit provides a mutualized managed service to solve all the problems as well for firms across the space.
Yeah.
Excellent. Sorry, Clifford Allen.
Yeah, I also want to add one more point, is the automation that we are constantly looking at. It's not just about the reduction of costs, right? It's also about the creation of scalability for us to absorb more volume. For example, in Hong Kong, we are adding 5 to 6, 7, 8% of listed company every year, and including stock connect business. We have a huge amount of growth every year, right? Without certain amount of automation, all we can do is just a very manual process and adding that number more people's, that many number more of many processes to our workflow. So that doesn't mean that we can eliminate the risk. Sometimes automation is really help us to focus on the right thing as well. For the AI example that I talked about, even though we have some kind of automation, it's not like we are going to eliminate the control perspective. I think we are putting more on our control than ever, but just to reduce some of the kind of, I want to say, tedious work. Those are the areas that we want to kind of eliminate, minimize, and focus more on the value-added processes and where we can tighten our control.
Excellent. Just mindful of time, I just wanted to quickly go around the panel and get some final thoughts. And it's clear that more and more solutions are coming available from, automation, increased efficiency, but it'd be interesting to get, the panel's thoughts on what areas do you see are still lacking in progress, and what's the way forward? I mean, Alan, you've mentioned automation, 12, 18 months out. Where are we needing to focus?
Well, I think aside from the technology and the infrastructure perspective, one of the key areas that we want to focus on is around the regulatory boundary that I think Gary and also everyone's talk about, is as much as that we want to change, there are certain boundaries we cannot break through, right? So we are working with parties like our ShareRed to look at all the jurisdictions, not all, but the major ones who have listing in Hong Kong. What can we do around the company ordinance perspective for the respective jurisdiction, and also each of the articles of the articles of each of the listed issuer. What are the boundaries, especially on the instruction processing? Sometimes it's quite spelled out that you need to have submit paper with wet ink. So what can we do as an alternative? So we are exploring a lot, investing a lot on kind of steering and changing the market on that space.
Gary, 12, 18 months out, where's your focus?
Yeah, I'd say in the corporate action space, we've got, again, a lot of focus, as we should have as a custodian right now, on the technology evolution that can play a part. I think we certainly need to work together as an industry to talk about, okay, what are the nuances, or what are the key points of an efficient corporate actions workflow that we think should be should be the focus across the industry, across the region, using industry bodies to help push that, but also taking into account and recognizing that markets will still have different ways of doing things and different requirements in those markets. For us, again, technology plays a big part of that, and so we're working very hard on a solution we called Smart Elections, which is focusing on using smart contracts in the corporate event election space to allow for much more complex standing instructions and much more automation from end to end, with the idea of then potentially overlaying the blockchain capability as well to give visibility to different parties of both the announcement but also the elections at the same time or at an earlier stage, to hopefully reduce some of the challenges and risks that take part in that part of the process.
Ankush, what are your thoughts?
Yeah, I mean, if I look at the next 12, 18 months, I would also look at what happened in the past 12 months and what that made people realize was the importance of workflow, a digital, but modern technology-driven workflow more than anything else. So leveraging these latest technologies, leveraging things like cloud, etc., APIs, RPA. So all of the technology solution, I think the digital workflow and interacting with all your other stakeholders, whether it's settlements or it's some other department, tax, I think that is where I think the firm should focus on more. As an industry, of course, we need to look at as Alan was touching upon. You need to have the regulatory support to provide an impetus to standardization. We work with an exchange in Asia trying to helping them automate capture from issuers, but that wouldn't have happened if the regulator wouldn't force the issuers to do that. So that's where there's a lot of roadblocks till you get a mandate from the regulators that you have to announce corporate actions in this way using digital tools and standardized data formats. You won't get that efficiency. So that's where the industry should come together and look at those aspects. And 12 to 18 months out, definitely all these market nuances. We talked about these challenges. They are not going away. So how can you reduce the cost for the industries is through mutualization. Can there be a centralized data validation, mutualized service, etc., which can help every participant in the chain? So definitely looking at operating models, data sourcing strategy. I think that's key for me.
Barnaby, do you agree, or is there somewhere else that we should be looking?
Yeah, I think for me, just one of the stats that we did last year just sprung to mind, that when we asked the CEOs how actions were, they said globally, about 90% they thought corporate action was 90% automated. If you ask people in the back office, they said about 40%. So for me, I think, I don't go against anything that everyone said. I think it's absolutely right that on the solution side, there are so many solutions that, to Gary's point earlier on, were not available when we were last casting our corporate actions operating model 10, 20 years ago. But what we have not got yet, and what I would hope that this last year has really pushed to the fore, is that we need to understand our corporate action better. We've got to understand the true costs, the true risks, and as a result, then we'll be able to perceive the right solutions for those problems. But it is incredible how many people I speak to still every day who cannot put their finger on exactly where the problem is or the scale of the problem at an organizational level. So for me, until the CEO understands how big a problem this is, a multi-million-dollar risk center, you're not going to get people championing big investment projects. So for me, the business case first, and then the technology will come.
I think you've got our discussion for our next webinar, how to bring this corporate actions discussion to the board level, to the CEO level. But unfortunately, we're out of time. Today, we've only just scratched the surface, but we do welcome today's listeners to email us if you have any other further questions for today's panelists. With that, I would like to thank our panel of experts for their insights and discussions. Barnaby Nelson at the Value Exchange, Gary O'Brien at BNP Paribas Securities Services, Alan Chun from HKEX, and and Kush Zuti from IHS Markit. Thank you all for listening, joining our discussion, and we look forward to talking with you all again shortly. Thank you very much.
Thank you.
Thank you.
Thanks.